Hey everyone, I'm Scott Cunningham, aka Scottsy Business, and today we're going to be talking about my 20 rules for investing. I recently just did a 7 rules for saving, and what's really important is that you're not just saving to save because, if you just save, inflation is going to take a huge chunk out of your savings. You're not going to be making all that money from appreciating gains, dividends, all that good stuff. And then secondly, if you aren't just leaving it in your savings account, you'll probably find another place to spend it. Pizza, dining out, whatever. If you've got money lying around and you're not really doing much with it, you'll probably find a use for it. So it's better to lock that up into your investings and just, completely get that thought out of your head where you're going to maybe use that because you've got that available and since you're not doing anything with it. So it's very important to not only save, but to save so you can invest, because otherwise, you're not really building your wealth or, progressing in terms of your personal finances. So I have this video for 20 rules for successful investing. This is by no means financial advice. This is just what I personally did in the past 18 months or so to build my net worth from about $5,000 up to now over $120,000. Obviously, I was putting money towards this about probably like every month, really. But I obviously didn't, put in $120,000. I grew this a significant amount. And there's a lot of different ways to invest. There's so many different investment strategies. There's all these traders, signal groups, a million different things that you could maybe follow. But for me, I think you should play it the legit way, not looking to get rich, but rather following a proven strategy where you're doing the right things, you're investing in the right things, you're risking it all, and you're not doing anything crazy. You're doing what makes sense, what works, and you're just following a proven strategy and step by step, and you just go through and you make your investments, and it's as simple as that. These 20 rules that I followed very rigidly have allowed me to grow my portfolio from $5,000 to over $120,000 in a very short period of time. And I believe that if you follow these same rules or guidelines, you can do something very similar for yourself. And this is more so about what not to do so that you avoid, you're looking to get rich and then you fall into all these different little like traps, courses, signal groups. You're trying to get rich, off one trade. So you're doing all these really crazy trades. You're trying day trading, penny stocks. All of that is crazy. All right. It's not sustainable or a good proven way to make money for the majority of people. Now, while you can still do a lot of these crazy investing methods and you might make money, it's not replicatable. Like, it's not easy for everyone to just do that same thing. It's not sustainable. It's not reliable. So instead, we've got these 20 rules for you guys to follow. And this is how I achieved my wealth. And I believe that you can do the same thing if you follow these rules to a T. But again, you can kind of do things. You use the rules that make sense for you. You don't have to follow this rigidly, but I suggest that you do, but this isn't financial advice. So, yeah. So let's just get into it. Number 1 is buy low, sell high. Now, this is very obvious, but a lot of people don't do this, right? Because they invest emotionally. They see something goes way up and they want to get in too. They fear that they're going to miss out. And a lot of people do this and they don't follow the simplest first rule, which is just buy low and sell high. Do not buy high and sell low, whatever you do. All right. We'll get into some of the caveats of that with some of the other rules. 2 is focusing on fundamentals. So don't go chasing things based on hype. Don't go, because there's a lot of people investing in technology, especially electric vehicles right now. There's so much hype around that. But you should really just focus on companies that have great performance. They have a long history of, paying their dividend or whatever it happens to be, whether it's growth stock or dividend stock, that proves that fundamentally, this stock or this cryptocurrency has performed very well and will likely continue to do so. So for me, when I'm looking at fundamentals of cryptocurrency and I want to invest in something that is scarce, has a great store value, and will likely go up in the long term, I look at something like Bitcoin, right? So that's focusing on fundamentals. 3 is don't invest in everything. Don't spread yourself too thin. This is pretty obvious. It's just you should be diversified, but if you diversify too much, then you open yourself up to more risk, right? So I originally did this because I wanted to be so diversified. I wanted to be diversified across every single sector, at least for stocks, and I was pretty diversified for crypto as well. But the issue was that I wasn't able to keep up with everything because of that, and because everything was so spread out. If I wanted to liquidate my portfolio or make some drastic changes, it would take way more time to actually achieve that. So spreading yourself out too thin is definitely not ideal in terms of portfolio management, as well as being able to actually keep up with everything that you've got going on, because you do want to stay on top of your investments as well, which is one of the other rules that we'll get to. 4 is invest locally. So I think it is ideal to invest in growing markets, and you could definitely make a lot of money investing in other places. But the problem is that, at least in my circle of friends, when you're investing in outside of North America, at least, like outside of our local area, we don't know the politics, we don't know the laws, we don't know what's going on with their financial system. We're not paying attention to, their money supplies in these different countries and like what kind of stimulus checks they're getting, all these different things, like how COVID is affecting everything. It's almost impossible to keep up with all this different stuff, let alone being able to do that for my North American stocks and all that stuff. So when you have to keep up with every single country's politics and all this different stuff, you make this a full-time job. So naturally, if you just invest locally, you will be more aware of what's going on. You'll hear about things as they're happening. It makes it a lot easier. Obviously, if you want to play with more risk and you want to potentially have bigger upside for reward, yeah, you might want to invest in emerging markets. But the problem is that a lot can happen that you might not even hear about or be aware of, and that's going to make it a lot harder for you. And you're going to have to dedicate significantly more time to managing your investments, because most people do not even come close to what they should be doing for managing their portfolio. So you don't want to make this harder for yourself. 5 is utilize compounding interest where possible. So personally, I'm very, very keen on dividend stocks. And when you've got a dividend paying you, you can take that dividend, and then after you've gotten enough dividends, then you reinvest that into more dividend stocks and then earn more dividends, and then you reinvest that, and you keep going, you keep compounding that interest, so that you're continually buying more and growing your portfolio within the portfolio itself, and not having to add more money and do things like that. And this is more exponential. You get more gains more exponentially over time. So the earlier you start getting dividends and compounding interest, the better off you're going to be in the long term. So utilizing compounding interest is a very, very powerful financial tool. 6 is only trade with money that you have. So because you're not a genius and you're probably not an expert trader, I don't expect you to be trading options, margins, taking out loans, all this kind of crazy stuff. I wouldn't even do that, like myself. And even in a few years, I don't plan on ever doing something like that, because playing with money that isn't yours is very, very risky. Expert traders can do a good job of this, but still a lot of people lose a lot of money playing with all these different financial tools. And until you've really mastered the basics, a lot of the stuff that we're talking about here, you should not think about going into the super advanced stuff. And I would just stick to the basics. Personally, I plan to only do the basics. I don't think that doing margin trading and options is it's just too risky in my opinion. And yeah, you can make a lot of money if you know what you're doing. But I would argue that most people have no idea what they're doing for margins and options, and most of the things that you can do, like shorting, all that different stuff, I think a lot of that is way over people's heads, and you should just focus on the basics. And like I said with number 2, focus on the fundamentals. All the rest, there's so much out there to actually like figure out and learn about, that you'll never wrap your head around all of it. And then, and then here comes crypto, and that's a whole other thing. So you're better off to just stick with the money that you actually have and just trade with that. It's the safest way to go, honestly. So 7 is dollar cost average in with every paycheck. So I do this where every time I get paid, I just invest like the majority of my paycheck right away into stocks and or cryptocurrency. And I think this is the better way to invest, because if you're doing it, if you're dollar cost averaging in versus the other option, which is lump sum, where you just you have a bunch of money saved up and then you go in when you think it's the best time. So the reason I think dollar cost averaging is better is because A, you're not holding on to this money and then you might do something with it, like buy a new car or whatever it happens to be. When you're dollar cost averaging and you're doing what I'm doing with dividends, you're not losing, value to inflation just by holding it in your bank account like you would with a lump sum. You're taking advantage of, you're getting those dividends, you're getting that compounding interest, your stock is appreciating or your crypto is appreciating in value, and all of these things that you get by just going into it right away, you will not get if you hold on to your money for a while waiting for the best time. And you could have the situation play out where the market only goes up and then you held on to your money and then now you've just got to pay significantly more. But when you dollar cost average in, you lower that risk and you will invest at the top, at the bottom, in the middle. And it typically plays out better because, you're, like I said, you're getting dividends, compounding interest, appreciation, you're not inflating your money. So all that adds up and it typically performs better this way. Now, if I got an inheritance or if I just had a lot of money sitting around, I probably would invest that all right away. But I dollar cost average in because it's just as I get paid. So naturally, with your income, I would suggest you should just go right in. But if you've got like a big chunk of money, I would say probably investing that into crypto or the stock market is a good bet to do that sooner than later, and not just hold on to that money. Because again, the longer you hold on to it, the more it's just getting chipped away by inflation. So 8 is keep up with your investments. I mentioned this before, but if you don't keep up with your investments, you have no idea what's going on. You don't know if something crazy is going to happen if you need to sell. So naturally, you want to keep up with all of your investments. You want to follow them, follow the news. That's why I mentioned it's better to invest locally, because then you only have to keep up with like the stocks themselves, since you're probably already somewhat aware of the news and politics going on around you, and you don't have to keep up with that much more. Because then you obviously also want to keep up with the companies that you're invested in or the cryptocurrencies, and just kind of stay on top of the news and know what's going on. I think that's very important. 9 is invest long term. So I'll talk about this later, but day trading is a bad idea. Doing a lot of short term stuff is much more advanced, I would say. And for people who are not expert traders, which I would beg to say is, or I would argue is most of you, I would say that it's better to just invest long term and hold on to your investments, not just because it also makes you have more conviction, right? You're not going to hold on to some random stock that someone gave you a tip about. You're not just going to hold on to that for years and years. You have no idea if it's worth anything, if it's good. But if you're going for high conviction stuff that you really believe in, you're fine to hold this for multiple years. And that's the way that you should be going about it. You shouldn't be investing in things that you don't have a lot of confidence in, have high conviction in, that you'll invest in them even if it goes down. Because for you, if it's a good investment, then you're just getting it at a better price. Whereas if it's just a terrible investment that's tanking, you're buying it on the way down, headed to the bottom, which is awful, and you're going to lose a lot of money. 10 is research before buying. Know what you're investing in. Again, this should be obvious, but you should know what you're investing in. You shouldn't just be investing in random things based on tips, etc. You should have an idea of what you're investing in. I don't think it's so important to like understand all the technology behind Bitcoin to understand why Bitcoin is a good investment, in the same way that most people who will watch this video know little to nothing about how the internet actually works, but they're more than fine to use the internet, and they like the internet and they think it's a great technology. In that same way, you don't need to understand the inner workings of Bitcoin to understand that it's a very good technology and that a lot of people are investing in it, and it has a great use case compared to traditional finance. So that is why you should always know what you're investing in. But that's a little caveat for crypto, because I would say probably most people don't know what they're investing in for crypto. That's why I would just invest in ETH and Bitcoin. That's basically what I am doing most of the time. 11 is don't day trade, because you'll probably lose money. Most people who day trade lose money over not even a very long period of time. Like, it doesn't take a long time to start losing money when you day trade. In a bull market, it might be a lot easier, but then, things can change and you could lose a lot of money regardless of the market you're in anyways. But it's definitely a very, very risky game, and I would not recommend day trading. The people who are probably watching this video probably shouldn't be day trading, because I wouldn't expect a day trader to watch this. Maybe they will. And I'm sure some people will be a little offended because they probably do day trade and they don't like that I'm saying you shouldn't. But it's just not a good safe way or reliable way to invest your money. And it's not a good way to build long-term wealth to actually, be able to retire eventually, because the whole point of everything that I've been doing with all this is that I want to retire before I'm 35. Essentially, I wanted to retire within 10 years of starting this, which was last year. The goal is, if you can save 65% of your income and invest all of that, you can retire in 10 years or less. I intend to retire before I'm 30, actually, but the original goal setting out was 35 because of the 10-year sort of, thing that the benchmark that they give most people. And I'm testing this out and then sharing the whole journey with you guys. So don't panic sell or panic buy. This goes to what I was saying before about, fear of missing out. You should not buy something based on emotion, or because you're afraid you're missing out, or you're afraid that it's going to crash. Everyone thought Bitcoin was going to crash because it went down a bunch, and then a bunch of people sold, and here we are back up pretty much where we were before that. So naturally, panic selling and panic buying is not going to work out for you. Just do not do that. 13 is do not trade based on emotion. Almost the exact same thing, but this just covers anything else. Panic sell and panic buy definitely needs its own specific call out, but trading on emotion in general, right? Because you could say, oh, well, I really like this company, so I like, not like because you have high conviction and it's a very, very good company, more like, I grew up with this, or I'm nostalgic, or something where your emotions are the ones driving your decision, not the logic, right? Because, if Bitcoin went down, it wouldn't be emotional for me to be like, oh, but I still like Bitcoin and I want to invest. It would be like, oh no, this is objectively an amazing store of value, an amazing investment. If it's cheaper, that makes sense for me to buy low, which is the first rule. Whereas if it was like, some random cryptocurrency like Doge. And I was like, oh, but Doge is so funny. I really want them to do well. So I'm just going to invest because I think I think that's really good. And I think it's funny. And Elon Musk occasionally tweets about it. That's emotional. Like, that's not a very rational way to be investing. So do not trade based on your emotions. Trade based on the data, objective things, the fundamentals and everything else that we've been talking about. Diversify your investments is number 14. Do not invest everything in just one asset. So kind of the opposite of 3, but you should be diversified, but obviously don't, spread yourself too thin, which is number 3. And don't invest everything in just one asset, because that is not going to be very good for you either if something bad happened to that. So diversifying your portfolio could be, diversifying the sectors or like the use cases, or even, where you might store certain things and security. So I'll give a few examples. In terms of on the low level, like for stocks, how I diversify sectors, I like to invest in real estate, insurance, banking, utilities, and then some ETFs. So that's how I'm diversified there. And then how I'm diversified in terms of the actual stock exchanges is I trade on 3 different exchanges. So just in case there was an issue with one of them, it would only affect 1/3 of my wealth. And then you can keep diversifying, but again, you don't want to overly diversify where your money's so spread out that it's very challenging to access everything. But diversify where possible, have different streams of income, all that good stuff, because it just exposes you to less risk if something were to happen to one of those investments. Like, for example, if you were only invested in real estate and the real estate market crashed, that would extremely affect your portfolio. But say you were half and half, then only half of your wealth is affected by that. So the more you diversify, the less affected you will be by, one single asset class, having a major event happen or whatever it happens to be. But it also, reduces your upside. So if the real estate market did very, very well, but you only had, 20% in real estate, then only 20% of your real estate is going to do very, very well. So, obviously know where you want to break things up and diversify, but you should be somewhat diversified, never just all in, one small sector or, one asset class. 15 is don't follow what everyone else is doing. Sort of what I was talking about, FOMO, tips, everyone's, jumping in on the bandwagon. That's not good. I mean, at that point, it's basically about to hit its peak. And once everyone is doing this one thing is when it's almost time to get out, right? My dad has been pretty successful with trades. And, a story that he always told me was, once you're at work and you're finishing up for the day and the janitor comes by and he's like, oh, have you heard about Tesla? I'm investing in Tesla. It's such a great stock. And it's like, once everyone from the top guy to the very, very last guy, not that, there's anything wrong with being a janitor, but once literally everyone knows about this, the next big thing and everyone's invested in it, that's when it's almost done, because a lot of people will buy things when they're high because they have the fear of missing out. So like we said, buy low, sell high. A lot of the times when you're selling high is to all these people who are getting in at the last second. And that's when it's almost done. So I don't think we've come even close to that for Bitcoin, at least for this halving cycle. I think we still have until October or November. But I mean, at the same time, I will say for 15, people could be doing something that is good, right? Like there are a lot of people getting into Bitcoin right now, and that is good. But it's definitely not what everyone is doing. Very, 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 very few people in terms of the overall global population are actually, like the percent of the global population are actually invested in Bitcoin. So it's definitely not what everyone else is doing. I can assure you that much. And just again, to that point is, if everyone is doing it, you should expect to get exactly what everyone else is getting. So if everyone else is just, doing okay, then you should expect to do okay. The people who are invested in crypto might do amazing, but they're not doing what everyone else is doing. I can assure you of that. So if you want to live an extraordinary life, you've got to do extraordinary things. You can't just do what everyone else is doing and expect a different result. 16 is avoid liabilities and acquire assets. You don't want to own things that drain your money. A liability is anything that takes away from your money and adds to your expenses. An asset is anything that will appreciate in value or generate an income. So for some people, a house could be an asset. And for some people, a house could be a liability. If all of your income or expenses are going to paying a house, then you have no funds for investing. And, if something were to happen and you couldn't pay your house, and then, tons and tons of terrible things could happen there. But say you own a house and it's paid off, and that allows you to take all the money that you would otherwise put into that into investments, or say you own a house and you're renting it. Those are assets. If you buy a very nice car, that's a liability. But if you buy a luxury vehicle that will actually gain value while you own it, that's an asset. So the same types of things can be assets or liabilities, depend on how you use them. So it's very important to, as much as you possibly can in your life, to avoid things that are going to cost you more money and increase your expenses, and get more things that generate an income or appreciate value, because you're either going up or you're going down. One way you're going up and the other way you're going down. 17 is do not blindly trust actual or perceived authorities. And what I mean by this is, you've got all these people doing signals groups, selling courses. You've got all this crazy stuff. Whether or not the person really is an expert or you perceive them to be an expert on TikTok, you should not just blindly do what other people are doing, or, they say, I'm investing in this, so you should too. You should never just do that. You should always do your due diligence, always do your own research, and never just go after things based on, hot tips, like a stock tip, or like, oh, this cryptocurrency is going to blow up, so invest in it. Never do that, honestly. Do not blindly trust actual or perceived authorities. I think a good way to imagine this is, think about it like it was anything else, right? Like if your doctor was coming in to do a knee surgery, or rather a surgeon was coming in to do a knee surgery, and they said, oh yeah, I learned this on TikTok. Like, how would you feel about that? And obviously you would not want them to do the surgery. And yet so many people are taking the advice of TikTokers and like random signals groups with people who they've never met. And none of these people have any accountability whatsoever for if something bad happens because you listen to them. And yet people just believe that. You should be more distrusting of other people regarding your finance than anything else, right? I'm like more likely to trust what my doctor says and less likely to trust what, my financial advisor would say. So you should be more skeptical of any financial advice at like whatsoever, specifically if they're trying to get money from you, right? I mean, I would say, you can trust this advice because I'm not trying to get anything from you other than help you guys do better. And maybe you subscribe to the channel, give this video a like, share it, all that good stuff, But blindly trusting all these authorities is very, 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 very sketchy, and it could lead you down the path to being scammed, which I absolutely do not want for you. 18 is understanding bull markets and bear markets. So this kind of goes to the last point where, you could follow a signals group and you'll be in a bull market and basically anything that they pick might go up. Basically anything that you pick might go up. And in a bull market, a lot of things are going to go up. But then once things switch to a bear market and everything is generally trending downwards, you've got to be picking the perfect stocks. You have to know what is going to be good in the long term. If you were day trading and doing all this other crazy stuff and then it switches from a bull market to a bear market, you're going to have a very, very rude awakening. And a lot of the people who started investing recently have been investing in a bull market. So they have no experience with a bear market, which, I've been treading through the last like 3 years, at least in crypto. But these people have no concept of what that's actually like. So they think, the stock market is just you invest money and you just get free money. And it's as simple as that. And that leads me to the next one, which is 19, which is you are not a genius. So a lot of these people, they make trades in the bull market and everything works out super well. And they start to think, oh, I'm just amazing at this. Like, I'm just so good. Let me just invest everything in this next one. The problem is that these people get like an inflated ego because, again, bull markets are very easy for anyone to make money. So you're not special if you make money during a bull market. That's why I say I'm an amateur trader, right? Me turning $5,000 into $120,000 doesn't suddenly make me an expert. I'm an amateur, but these are the rules that I followed to do this. And humility is much more important than you might realize. If I thought, oh, I'm a genius, I turned 5,000 into 120,000, and then I was like, I'm going to bet all 120,000 on this one thing because I'm good at making money, and then I could lose it all. So people who get into this fallacy of thinking that they're like a genius because, they've made some good trades, that's very, very, very bad, because it's going to lead you down the route of making crazy trades. Or when a bear market comes, you're going to have no idea what's going wrong or what happened to your magic touch. The last one is 20, which is take advantage of good arbitrage and avoid bad arbitrage. So just recently, a friend of mine, when Bitcoin was at a low and Ethereum was at a high, switched from Bitcoin to Ethereum. I mean, luckily he explained to me later, like, no, he'd made the trade a few days ago, but had he have done that, that would have been very, very, very bad. So, for example, I mean, this was the thinking that he had, was that Ethereum is going to go up, Bitcoin will either stay the same or go down. If I switch my Bitcoin into Ethereum, I'm going to make more money this way. So that's a good arbitrage. But the problem is that Ethereum being at like an all-time high or near an all-time high, and then Bitcoin being very, very low, you've got your money in Bitcoin valued way less at this current time, and then you're buying the more expensive thing. So you're losing all that value that you appreciated previously with Bitcoin. And it's arbitrage where you're able to, like, something goes up in value and then you can buy the cheaper thing, and then that increases your gains once that goes up. But you can also have the opposite happen. And this was more of like a fear of missing out kind of thing, where it's like you see Ethereum going up and you're like, like it's going up and I'm missing it, so let me just sell everything and go into Ethereum. So you sell all your Bitcoin, but without thinking about the fact that Bitcoin is at a low. So by the time Bitcoin gets back to its high, you'll still have more money than if you did this trade and switched to Ethereum and then got, 6 or 7% off the Ethereum gain, because then by the time Bitcoin goes back, you'll get 10% or whatever. So you'll make more if you just stick with the thing that was, down, because you should not be trading at a low to a high. This just goes back to the very, very first rule. So obviously avoid bad arbitrage, which you would only end up doing if you were kind of doing like a fear of missing out, or you were kind of rebalancing at the wrong time. And then obviously take advantage of good arbitrage. So if Ethereum keeps going up, there's really good arbitrage from Ethereum now to Bitcoin, because Bitcoin is really down. So it might make sense to then take your Ethereum and invest into Bitcoin, because then you can get all those gains when Bitcoin does its next little run. But right now it seems to be like an alt season-esque time, a little bearish. We'll see how everything plays out, but that is everything. While, these aren't necessarily to follow exactly, because, you might still want to do lump sum investing instead of dollar cost averaging, or you don't want to do dividends, you want to do growth stocks, whatever you want to do. I mean, obviously, there's no perfect way to invest, but this should really give you the right foundation and like structure and guidelines to follow so that you at least avoid amateur mistakes and you have a direction in mind for what you should generally do and what you should avoid doing. Again, none of this is financial advice. I'm an amateur, but this has allowed me to make more money than I would have ever expected. I would never have thought that by the time I was 26, I would have over $120,000, let alone that I had $5,000, in my portfolio when I was 25, and then growing that in just a year. And if I can continue that performance, I will be able to retire in like 5 years rather than 10. And I love to continue to share that journey with you guys. If you are curious at all what kind of stock picks and crypto buys I've been doing, I do put that out every month in a very detailed report. I also put out all of the earnings that I get from social media on crypto blockchain, which is actually quite substantial lately. So you can learn about all that good stuff with my other videos. But let me know if this was helpful for you. What are some guidelines or rules that you use for investing? Am I missing anything important? Do you disagree or agree with any of these? Let me know all that good stuff in the comments below, and share any tips and strategies, things like that, for anyone else to follow along as well. I'm sure other people will be able to benefit from that information as well in the comments below. So I hope you enjoyed this. If you did, definitely like, share, subscribe, and comment number 1 ham in the comments below, so that way I know that you watched the whole video. And I'd really, really appreciate that. So anyways, thank you so much for watching. Until next time, I'm Scott Cunningham, aka Scottsy Business. Cheers.